So we still continue to forecast a 70 to 85 range for Brent crude oil prices, with risks to the 70 to 85 range in the short term skewed to the upside because of potential drops in sanctioned supply, not only from Russia, but also from Iran. But then if I look further down the forecast horizon, the risks, I think, are skewed still to the downside given very high spare capacity.
And when you mention the risks to the upside from Iran, you're referring to foreign policy in the incoming Trump administration and the likelihood of maximum pressure sanctions against Iran, which could displace, we're talking 1 million plus barrels a day of Iranian crude, yes?
Yeah, that's correct. So to quantify the upside risk to Brent prices, if we were to see a scenario where temporarily Russian supply falls by 1 million barrels per day and where Iran's supply persistently falls by 1 million barrels per day, in the context of a return to a maximum pressure campaign, we estimate that Brent could spike to $90 per barrel. However, we assume that in this scenario, OPEC Plus would raise production for longer than in our base case where we only have 4 months of production increases. So the impact on 2026 prices is likely limited, but I think the risk in terms of prices in the short term are still skewed high.
What about the U.S.? Where does the U.S. oil and shale oil and shale gas actually factor in this equation, if at all?
So we have a modest supply-driven surplus in our base case for 2025, a 400 KBD modest surplus. It's driven by the supply side, especially with U.S. total liquid supply likely to grow by another 700 KBD. That's really quite solid. Not only coming from crude in the lower 48, but also the Gulf of Mexico is seeing 3 significant new projects. And then natural gas liquids, NGLs, a bit technical, but they continue to grow at a very rapid pace as the Permian continues to get gassier.
Let me ask you, Scott Bessent, incoming Treasury Secretary, part of his 333 is 3 million extra barrels, right? The U.S. is already at record capacity, right? At the end of the day, look, it's not going to be the White House that tells these guys to pump more. It's going to be Exxon, Chevron, whatever, who make their own decisions. With oil at around about 80 right now, is it profitable for them to produce more, do you think?
So the target that incoming Treasury Secretary Scott Bessent has defined is defined in terms of 3 million barrels per day of oil equivalent. Equivalent is the key word because that means that you can also include natural gas. Yeah. And we have this big surge in LNG export terminals, which will boost demand for U.S. feed gas demand. And it also includes, in our view, NGLs, natural gas liquids. If I look at our forecast, achieving this 3 million barrels per day of oil equivalent target is achievable in the next 4 years. In fact, if I look at the 3 targets among the 3 arrows, I would argue that the energy production target is the most achievable. You could argue that the 2 other ones are difficult to achieve at the same time. Growing above 3% GDP is not our base case, but it may be possible if you run very easy fiscal policy. But then it's very difficult to have a deficit below 3%.
So the big question is, how long